Grinnell Capital is a boutique asset management firm based in Park City, Utah.
Good morning. My name is Frank Grinnell. I've been investing in the stock market for over 20 years. It serves as my day job, and most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we share high-conviction ideas with subscribers, and we actively manage stock and ETF models for financial professionals and their clients, as well as individual investors. For more information, check out our website. Before we get to today's podcast, be sure to hit subscribe. And now, today's Street Views. Hey, good morning. Welcome to Wednesday, the 7th of December, 2022. Okay, once again, the market has failed at resistance points, the downtrending line. We see it here, S&P 500. We talked about the market's at a really important spot the past few days. We talked about the idea of putting on some protection last Thursday, Friday, I think even Monday. But you can see it here from the highs in January. Boom, right there, the first fail, and it looks to be another fail right there as we dip down lower. And the same's true for all the major broad indices, honestly. The Russell 2000, if we look at Qs, they didn't even get up there. Triple Qs, there's their downtrend line. Didn't quite see it in terms of testing it. So, yeah, they're not quite there. But nevertheless, I think it's, assumed direction lower at this point with fits and starts and rallies intermittently and what have you. We did get some good news on unit labor costs for Q3 coming in at 2.4% versus 3.1 expected. Rates were up prior to that release, and as it came out, they reversed. Now TLT, you've got looking over 108, 108 and a half right now. Pre-market, you can see it up there. That looks real nice, up 1.5%. Hopefully you are along for the ride in the TLT or some other form of government bonds. We've been talking about it for a while. It feels like, the wages component of this is really one of the toughest components of this whole puzzle. It's a key component of the services side of inflation. So you get the Fed has to really crush jobs, crush wage inflation. This is a great number to see. It'll help us hopefully move past the inflation risk and focus on the earning situation, which isn't great because everyone's just been battening down the hatches here. So earnings continue to come down for 23. That's still got a little ways to go. But as we've talked about a number of times, and I've talked about in my talk, it gets easier to model an earnings recession and an earnings bear market than an interest rate-led bear market, in my opinion. Okay, so that's, I think hopefully see treasuries continue to resume their old flight to safety status, and you can actually make some money in the bond market as we have been able to for now about a month. Okay, MongoDB, awesome quarter, actually put up a profitable quarter, extremely expensive, but a fantastic growth company. New partnerships announced. This is the kind of stock that I'd be buying hand over fist in the normal times because of the growth, because of the moats, because they're just crushing competition out there. The new Atlas product. This is one of the premier software companies to own, in my opinion, along with Snowflake. But the time I don't think is quite yet. You're going to have a nice big gap up. Look at this thing up 26% this morning. It's going to open up somewhere, I don't know, 180, yeah, up around this range. So it's happened with a number of other tech names, and they've all given it up in the days to come. We'll see what happens here with Mongo. Again, I still think, unfortunately, it's too early, even though they are showing good signs in profitability, which is great. We're guiding the profitability for the next quarter. I did tell you about an emerging market play that potentially could be interesting. Brazil is what it is. There's an ETF that I actually wasn't aware of before. I'm going to call it Flubber, FLBR. It doesn't have a ton of liquidity. It trades pretty thin, so not a big deal if you're only buying, 5, 10,000 shares. But if you got to buy a bunch, it'd be kind of an issue. But anyway, the story with Brazil, real quick. They had a recent election. The new ruler, Lula, the new guy, I don't know nothing about him. I think he was there before, if I'm not mistaken. But he promised to reindustrialize Brazil, attract more foreign capital, looking to increase fiscal spending in 23. The central bank over there has been very aggressive to fight inflation. Trades at a 6.9 times, just under 7 times on PE. Latin America trades at 7.5 in general. Obviously, we trade much higher than 7 times. And it is cheapest in terms of expense ratios on the Brazil ETFs. And the Flubber, FLBR, has a yield of 11%. 11%. It wasn't there. Yeah, semi-annual dividend of $1 and change right there. 11%. So, I mean, the bigger play here for me and why I'm thinking about it is more on the material side. Things that I see going forward, they're going to be important in terms of copper, energy, all these kind of real asset, very strong real asset economy. Something to think about. Have an awesome day. Talk to you tomorrow.
And now for some important disclaimers. This podcast is intended for financial professionals only. Grinnell Capital LLC is a state-registered investment advisor located in Utah. Services offered by Grinnell Capital can only be offered in the states of Utah, Idaho, California, and Texas, where Grinnell Capital is registered or where otherwise legally permitted. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisor.info.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be consumed, construed at the provision of personalized advice, and is subject to change without notice. This material should not be considered a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital LLC as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility. Therefore, this podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve long relative and risk-adjusted returns, primarily by investing and trading securities issued by companies that focus on the global information technology, consumer healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth potential and an abundance of both new and maturing product cycles, a field of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange traded fund, ETF strategy, with an investment objective similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some risk aversion in the event of significant market stress through investments and ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital LLC has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, www.grinnellcapital.com.